Hi, this is Dan Genter, CEO of RNC Genter Capital Management. And I just want to bring you an update for what's taking place in the capital markets during the last week, or really it's now been 2 weeks that we've been dealing with not only the health pandemic, but also the pandemic that we've been dealing with in the financial markets. So what really has taken place, ironically enough, and we talked about this a little bit on our last broadcast, is that the reaction of the overall market has not really been unusual. What has been unusual is the compression of the timeline. That normally what would take months has been happening in days. But when you take away that gut-wrenching feeling that everybody goes through when you see this type of timeline compression, the overall dynamics really have not been that different. Last week we had a fairly classic pullback that would be entering into somewhat of a recessionary environment, and that was that market was about 10 to 15% overvalued. You gave back that premium, then you came down about 15% from that, and we found ourselves last Friday closing it down roughly 30% from the highs. Very, very typical as the market starts to realize the economy is slowing, or you have something unusual taking place in the marketplace, that it's frightened, it's scared, it's surprised, and there's uncertainty. Now, as I mentioned last week, you can quite often, that's nothing where you're going to be exactly on those numbers. You clearly could drive below that, and that's what we saw this Monday. This Monday we saw us drive through that 30% level. We actually were down a little over 35% from high to low. And then in Tuesday, Wednesday, Thursday, we began to recover. And we've bounced off, well 10 to approaching 15% off the bottom. Even today, you saw a down day, but it was orderly. Everything was very, very orderly. You had a little bit of a more push of selling in the last 10 minutes, but that's very, very normal with so much program trading in the market. And people just don't want to go into a 2-day weekend with open positions with this much uncertainty. So the market itself really is acting fairly normal, trying to find a base and just digest the information as we go forward. Again, the market will take good news, it'll take bad news, it just doesn't like no news. So as we're getting more information, you're seeing a corrective pattern again, which is typical, but as we just mentioned, it's just been compressed into a matter of days instead of months. Now, the dynamics that we're seeing in the bond market have been really what's been unusual, because normally when you have a pullback in the stock market, you have a flight to quality. And the first place people go is to treasuries, obviously where the perception is zero risk. And then you go into high quality bonds. Usually the first place is high grade municipals, because they're backed in many, many cases by full faith and credit or revenues from municipalities that tends to be stable and tax receipts. And then you go into high grade corporates. So this is where the market really got out of shape, frankly. And it also exacerbated what was happening in the equity market. And what happened in the bond market in general is just a lack of liquidity. And that liquidity or lack thereof was really caused by tremendous selling by the mutual funds and the ETFs of fixed income obligations. It's also one of the classic reasons why we've said over and over again, if you're a large enough investor to have individual securities, individual stocks, and individual bonds in particular, you really don't want to be part of a fund or a commingled environment. And again, that's coming from a manager that operates a mutual fund, so I'm somewhat unbiased. It's just that you get caught in the watershed with everyone else, whether or not you want to sell or not sell, and you can't make any individual selective changes. And that's exactly what happened. You had a lot of people that were selling fixed income, both corporate, treasury, and municipal ETFs and mutual funds. And those managers, they have to sell. If you're getting redemptions, you have to sell. And you would think, well, they're going to sell and it's going to drive the low quality market down, but that's not really how it happens. When those managers are forced to sell because of redemptions, then what they do is they go sell the most liquid securities they have because they can get better pricing. And so you're actually going to sell your higher quality securities, and you're going to sell your shorter term maturities and hopefully get better pricing so it doesn't significantly adversely affect your net asset value of your fund. And that's exactly what we saw. We saw a rush for people having to sell these securities, and you had a situation where there were so many people selling. You just had sellers, you had no buyers, and so that means that institutions Large banks, large investment firms are going to have to take that into inventory. Because again, unlike stocks where it's a broker putting a buyer and seller together, in the bond market, they are actually buying it as a principal, taking it into inventory. So in this case, what happened is a number of the new regulatory limits were hit, and so large banks and brokerage firms could not take any more securities into their inventories and no more risk assets, and so that market got shut down. All right, now that's the bad news, and that's what happened. The good news is tremendous liquidity has now come back in the muni market as it's being backstopped by the Fed. The muni market is not 100% back to normal, but it's about 90% back to normal. And the corporate market is a little bit behind, but it's coming back to normal. So we're rapidly getting back to equilibrium in the credit markets as the Fed has provided support. That's supported the stock market. And I think that we'll continue to see normalization as we go forward. So as always, if you have any questions, then give your advisor here a call. And we are here operating at 100%, working for you through this situation. Thank you.